So what's up guys, your boy Mikhail here back again for another video, and today I'm talking about Binance futures trading. And so today guys, we'll be going internally into the Binance futures trading platform. And first of all, talking about the Binance futures trading platform, there are two main things you guys have to know about the Binance futures trading. First of all, there are two different modes for the Binance futures trading. Also, there are two different types of Binance futures trading, which is the USDT perpetual and the coin M perpetual. The coin M perpetual is where you use the coin to trade that particular coin for the trading of that platform. Like if I wanted to trade ETH, I would have to have ETH in my futures wallet to trade it. But what about using the USDT perpetual platform? I have to use USDT to trade. So as you can see, we're on the USDT perpetual platform, and going into the Binance trading modes, there is the cross margin and isolated, as you can see. So right now I'm using the isolated mode. As you can see, it says here that the cross margin mode, all cross positions under the same margin assets share the same asset cross margin balance. In the event of liquidation, your assets full margin balance along with the remaining open positions under the asset may be forfeited. So what does it mean? For cross margin mode, it means that in any position you enter, your liquidation price is being calculated with how much that is in your balance, that is in your futures balance. So if your price reaches your liquidation price, like your trade starts going the other way around and hits your liquidation price, the whole money on your futures account will be liquidated. But for the isolated margin mode, manage your risk on individual positions by restricting the amount of margin allocated to each. So basically what the difference is between both of them is that cross margin, if it hits your liquidation price, you lose everything. But for isolated margin, it helps you manage the liquidation price. So the liquidation price acts with the amount you use to enter the trade, not with the amount of your futures account. So that is why basically I always use the isolated mode, because isolated seems to be much better than the cross margin, because I don't want to sell a trade and it goes different ways for me and I lose all the money in my accounts, in my futures accounts. Instead, I set an isolated margin whereby if it goes the wrong way, all it liquidates me is the margin that I used to enter that particular trade, instead of taking out my whole account. So that's it for it. Let's go in more into this. Another thing you guys have to know is the leverage price. So there's a leverage from 1x to 25x, right? So what this leverage means is that 15x leverage, as you can see here, means that you multiply the percentage of the price move of whether if it's a BTC that you're trading or whatever. You measure the percentage move. So let's say I open a 1x leverage with BTC and BTC goes down 10%. I'll do 10 times 1, which is still 10% increase in my price. But assuming I'm using the 15x leverage right now, and maybe I trade BTC and BTC goes down 20%, right? That would be 20 times 15, because you always multiply the percentage by the leverage you're using to find how many percent gain you've made. So let's say 20% and it's 15. So 20 times 15 will give me about 300% increase in my money. And basically leverage just accounts for how much you make in percentage, or how much leverage you're willing to take, how much you're willing to risk to enter a trade. So if I'm using a 15x leverage, it also accounts for the size of the trade you're entering, also not just the balance, not just the amount you're going to make if it goes up, but also accounts for the leverage, the amount of leverage or size of the coin you're going to use. So if I'm using a 1x leverage and I'm trying to use $10 in, I might get 0.0001 BTC as my leverage. But if I use the same $10 with a 15x leverage, I might be getting to get 0.001 BTC. Instead of getting 0.0001, I get 0.001 So using that, it gives me a higher chance of earning more money, but also having more risk acquired. So that is basically what the leverage does for you. Also, there's also a limit and a market based platform on this. So what does the limit do? Limit is you setting a price target in which you want to jump into a trade on. And also market is also you setting, just putting in the size of BTC and allowing the Binance futures to choose whatever price the market is at, or just choosing the price, whatever price the market is at, for you to jump into a trade. There's also what is called a stop limit. So stop limit is like setting a conditional trade. So basically how you set a conditional trade with Binance futures is using the stop limit. So stop price is the price I would have liked for Binance to hit before they set in my trade. So let's say I want to enter at, let's say 33.7, right? And I feel like, okay, I believe, and you believe that maybe if the market hits 33.9, then certainly you guys are going to go below 33.7 to go further, maybe to 31,000. But you're not yet sure, because maybe you're in the you're in the top 34,000, and you're not yet sure, like, okay, I'm not sure that this is going to get down to that limit for now. So what you do is you just set, maybe as far as you think that 39 is a place that if it hits, we're going down further, and you want to set your entry price at 33.7. So I've already set my entry price at 33.7, right? So what I now do is set my my stop price, which will be the place where if it hits, it will activate my trade entry of 33.7. So I put in 33.9 here, and maybe I select, okay, let me go in with, let's say 50% of my whole account. So I also set a take profit and stop loss. So take profit is the price where you want it to reach, and then your account takes profit from what you've earned. So let's say I put 31,000 here as my take profit, and then my stop loss at 34.5, because your stop loss has to be higher than your entry price or equivalent to your entry price. It will also be below your entry price, but you have to have some gains already before you can set it below your entry price when you're doing a sell. This is when you're doing a sell. So this is a sell order, basically, not a buy order. A buy order means that I have to set my stop price lower than this, and my stop price lower than this, and then my entry price higher than it, because it just means, what it just means, a buy long means that your trade is basically, you're planning that the amount of BTC is going to go higher, and the price of BTC is going to go higher. But selling short means that the price of BTC, you believe it's going to go short, and it's going lower than the price is at right now. So let's say I'm planning to go sell short, so I press sell short. It asks me if I'm sure that I want to sell short. I sell short. So I go down right now, as you can see, order submitted. If I go down right now, I already have an open trade. So if I go to open orders, you can see that this sell order is here already, but it's still waiting to get activated. As you can see, it's still waiting to get activated, while I already have an open position here, which I set in about a few days ago. That's still here, and it's about 17% up in increase. So basically, that is how you set in a trade. As I showed you before, you can also set a conditional trade, which you guys saw me show you here using the stop limit. You just set a conditional trade. You can also set a limit trade of the price you want it to hit, and then it sells off for you. So let's say I want to put a conditional trade at 33.9. I want to put maybe a buy trade at 33.9. I want to use 52% of my trading portfolio for that trade, and I put my take profit at, let's say, 36,500, and then put my stop loss at 33,000. So what it means is that once my position hits this price, it will take me off the trade so I don't lose more money. If it hits here, I take profit from the gain I've made. So now I go to buy long. It asks me, I say do not show again, or I'll just leave it there because I love seeing it. So I make sure I set the trade I want. So I go buy long after 3.9. And if I'm to check my trade, it has been showing up here. Oh, sorry guys, it seems that my network is off. So let me just reconnect. Since my network is off, so let me just reconnect to the network. Okay, so I'm connected to the network. Oh, my order is set in again, as you can see. At the sell of this price, as you can see. So let's just reset that order because I think it didn't go through. So as you can see, I could press a buy long at 33.9. Right? So as you can see, 33.9 is set. My buy long at 33.9 is set in. As you see, sell. Let me check my position. I hope it didn't reset and I entered another position of buy long. No, I did not. So why is it showing it differently? Or did I just enter another? Oh, I just entered another position. That is crazy. So basically, I have to close this position because I just mistakenly opened another position. So as you can see, this is my margin ratio. This is the margin ratio for my trade. So margin ratios is basically showing you the amount of percentage in which your trade is. If it goes, starts shining, goes middle class, that means you're about to get liquidated. But if it's around 5 to 10%, that means you're not close to liquidation or you're even close to liquidation. So the more higher it goes, the more you get getting closer to liquidation of your assets. So let me just cancel some of this. Let me just see if I have any other thing open. So I mistakenly opened a position that I didn't want to open at all, which is bad because it took out my old trade, but I actually came out in profit, so that's good. So basically that is it for now on how to trade with futures, Binance futures. We're going to go in depth in some of these places like the stop limit for the conditional orders, and in the next video we're going to be talking about the cross margin and how to set orders on the cross margin.